For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir Technologies emerged as one of the most talked about stocks, delivering a remarkable performance with its share price increasing by approximately 4 times. This growth was driven primarily by heightened enthusiasm for artificial intelligence stocks as investors recognized the transformative potential of artificial intelligence across multiple sectors. The outcome of the United States presidential election further contributed to optimism, as the incoming administration's policies were expected to align favorably with Palantir's core business areas. However, 2025 has so far told a very different story. Since the beginning of the year, Palantir's stock has experienced a decline of about 7%. Over the past week alone, the stock has fallen an additional 11%, and it now trades at an estimated $68 per share. Several factors have combined to weigh down Palantir's performance in the current year. A key driver of the recent weakness has been the cautious stance taken by major financial institutions. Morgan Stanley initiated its coverage of Palantir with an underweight rating, signaling that the stock may struggle to outperform the broader market in its current state. Similarly, Deutsche Bank issued a bearish report on the stock, assigning a price target of $35 per share, which is approximately 50% lower than Palantir's current trading price. Adding to the negative sentiment, Cathie Wood's ARK Investment Management, a high-profile fund with a focus on innovative and disruptive technologies, has been reducing its position in Palantir. ARK's decision to offload shares has likely unsettled retail investors who often view the fund's moves as a signal of confidence or lack thereof in a company's prospects. Furthermore, macroeconomic conditions have created additional challenges for high-growth stocks like Palantir. Yields on United States Treasury securities have been trending higher, a development that typically reduces the attractiveness of growth-oriented equities. Higher yields increase the cost of borrowing and reduce the present value of future earnings, making it harder for companies with high valuations to justify their stock prices. Our analysis continues to categorize Palantir as a high-risk investment, and there are several reasons for this assessment. First, the company's valuation remains exceptionally high, standing at more than 150 times projected earnings for 2025. This places it among the most expensive stocks in the technology sector, especially when considering its growth rates. Second, Palantir's reliance on government contracts, which accounted for a significant portion of its revenue in recent years, introduces a level of unpredictability. Government spending is often subject to political and budgetary constraints, making it less stable compared to revenue from commercial clients. Finally, there has been considerable insider selling of Palantir shares, raising questions about the confidence of company executives in the stock's long-term trajectory. Despite these risks, Palantir's appeal lies in its potential to benefit from major secular trends. Over the past year, the company has demonstrated the ability of its artificial intelligence-driven tools to solve complex problems in areas such as national security, logistics, and healthcare. The incoming Republican administration, led by Donald Trump, is expected to increase federal spending on national security, immigration enforcement, and other areas where Palantir's software tools can provide value. Peter Thiel, the company's co-founder, has long been an ally of Donald Trump and is seen as having significant influence within the administration, further bolstering investor optimism. Reports also indicate that Palantir has been engaging in discussions with several leading technology companies, including SpaceX, led by Elon Musk. These discussions reportedly aim to form a bid on United States government defense contracts. Historically, these contracts have been dominated by a small group of large defense contractors, such as Lockheed Martin and Raytheon. If successful, such partnerships could significantly expand Palantir's market opportunities. Nevertheless, Palantir faces notable challenges that could limit its growth potential. One major issue is its reliance on the Foundry platform, which is designed to serve commercial clients in sectors such as manufacturing, healthcare, and retail. Although Palantir has emphasized the long-term potential of the commercial market, the company remains heavily reliant on government contracts. These contracts tend to be irregular and unpredictable, which complicates revenue forecasting and growth planning. During Q3, Palantir's commercial-related sales grew by 27%, reaching $317 million. However, this figure fell short of analyst expectations, underscoring the company's struggle to meet market demands in the commercial sector. At the same time, government-related revenues exceeded expectations, further highlighting Palantir's dependence on the public sector. Palantir also faces intense competition in the data analytics and artificial intelligence space. Larger technology companies such as Microsoft have the advantage of extensive ecosystems and cross-selling opportunities, allowing them to offer integrated solutions to clients. In addition, specialized analytics firms targeting niche markets pose a threat to Palantir's dominance in certain sectors. Over the past 4 years, Palantir's stock performance has been anything but stable. The company recorded an annual loss of 23% in 2021, followed by a deeper loss of 65% in 2022. These declines were reversed in 2023, with the stock delivering an impressive gain of 167%. This trend continued into 2024, when the stock soared by 340%. Such extreme volatility underscores the inherent risks of investing in Palantir. Looking ahead, investors remain divided on Palantir's future prospects. Given the current uncertainties in the macroeconomic environment, including potential interest rate cuts and ongoing geopolitical conflicts, the stock could face significant headwinds. The question remains, will Palantir experience another downturn similar to 2021 and 2022, or will it recover and deliver strong returns over the next 12 months? From a valuation perspective, Palantir appears overpriced compared to its peers. The stock currently trades at approximately 45 times forward revenue and more than 140 times projected earnings for 2025, despite an expected growth rate of just 25%. In contrast, Snowflake, a cloud data warehousing competitor, trades at about 12 times revenue while achieving similar growth rates. Nvidia, a leading artificial intelligence company, trades at 31 times forward earnings, with revenues projected to more than double in 2024, and consensus estimates forecasting growth of over 51% for the next fiscal year. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.